Check, 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 check. Hey, everybody. I just wanted to drop a little update, things that I'm seeing. I've been posting some slightly concerning metrics on some of my shows, so I just wanted to kind of go over some of those things. Definitely kind of an incredible rally that really we haven't seen by some measures in many, many years, even decades. So really quite spectacular kind of rally based on some of the positioning that hasn't been there. People have been on the sidelines. A lot of that has come back in now, so we'll take a look at that. And of course, there's the AI push, which I think is for real. It's happening, but it's also kind of sort of clouding a little bit of what's going on in the economy, which is things maybe softening a little bit. If you back out that capex spend, all the money people are spending on AI, it may be a drag on the economy in a sense that people are spending on AI, so maybe they can't, they're going to combine that with letting people go and things like that. So these are some of the things that we have to watch play out over time, unfold. This is going to be a difficult situation. The positive, of course, is that we are going to have incredible potential for productivity gains. That's going to work its way into margins, into profit margins, and what teams can do, right? 5 people will be able to do what 20 people used to be able to do. And so there's going to be this sort of known unknown. We know it's happening. We don't know exactly how to quantify it until we start to see some results. We're entering into a time where there's a lot of uncertainty as to how this plays out a little bit. We know a little bit more certainty as it pertains to NVIDIA and the builders, the picks and shovels of the AI revolution. That's a little bit more clear because we see those results. We see the sales. What we don't know is how this plays out throughout the economy, because this is the AI inference phase, right? This is the phase where you go from training and kind of plugging in a whole bunch of data into these AI agents, and you create something that's now going to deliver value, utility, usefulness. We saw that in the Microsoft earnings, which we're going to talk about in a moment. So, of course, before we move on, everything today is for information and educational purposes only. Please do not do any trades based on anything I say today. So if you're okay with that, let's move on and talk about what are we seeing out there. Well, we've got markets down a little bit. Let's take a quick look at markets. Definitely a nice little sell-off in the SPY here as some of the exuberance kind of unwinds a little bit. We can see that we've got basically this spot here, which was a really big breakout spot. That's sort of a natural place to go. I said on a show I said, we could have a 200 or 300 point sell-off. So here we are, and I've been showing some of the things that concern me a little bit. I'm going to show you basically one of them, which is quite amazing. I've been showing this. Of course, members got this. Let me explain how this works. This is the Sharpe ratio of a sale each and every day of a 1 DTE put. So you sell this 25 delta put and you collect the money, right? So the Sharpe is indicating that this is a very, very, a Sharpe of 10 is unheard of, right? A Sharpe, normally under normal circumstances of 1 to 3 is pretty darn good. A Sharpe of 10 is incredible. So what this basically tells you, without knowing too much about how the mechanics of this, is basically telling you that selling insurance on this market, no matter how low the premiums get, has been almost guaranteed money, right? So, and this is unnatural. You don't see this very often, a parabolic move. I showed one of these. I showed a number of charts like this in December, which sort of led me to believe we're going to get, perhaps a little shakeout where excitement for the stock market went parabolic as well. So when you see parabolas, the parabolas can continue, right? Could be on a stock, could be on an index sometimes. But when you see parabolas, they can go on and on and on. But when they break, they break abruptly, and then they kind of have a little denouement. They kind of sort of drift down over time. So it remains to be seen if this is a 1 or 2 day sell-off. But based on this, based on the amount of bulled up sentiment that people had, this could be a few days of kind of a bit of a shakeout to go along with the seasonality that we're going to talk about. So let's take a look at. So this is basically, look at this as a bit of technical damage here on the chart. So this is the S&P, and it's measuring how it's sort of the third time in history that the S&P, the SPY, has recorded 3 consecutive open to close drops from an all-time high close, like they've done recently. So the last couple times this happened, big sell-off. Last couple times, here's another time, big sell-off, right? So we've seen that lately. Fantastic earnings from Meta and Microsoft. Open, suffer. And then yesterday, of course, Amazon disappointed a little bit. We'll talk about that in a moment. So continuing on here, we can see this is squeeze sentiment. So think of this as, the COVID GME type squeezes, these companies that are a little bit more flimsy. This is showing you that we've had real exuberance in this area of kind of more speculative names, right? So this has been where everyone's been playing this very, very high, very similar to what we saw during COVID and the GME short squeeze craze. So that has to sort of unwind a little bit. And then, of course, this is a big one here. We see this frequently. In fact, we saw it last year. And you see this sort of period. July is the strongest month for the market, just about almost the strongest month. And we have this amazing sort of ability for stocks to just kind of push higher. Everyone's excited. And then it ends abruptly. So what you have is this interesting paradox of it feels like nothing can go wrong as a long, and it goes to nothing can go right for August and September, which is the worst 2 month stretch of the year before we head into October, and then things get a little better into the Christmas months. And you can see that play out here. We have the VIX kind of going down, and it feels like, man, market's never going to come off again. And then it starts to march up. The VIX, for those of you who haven't heard of it, is the fear index. So when markets are selling off, option premiums tend to rise, or we're just kind of riding down the skew curve, which is another story. But basically, it means that people are, getting a little bit more worried. Option prices are going up, generally speaking, and so that's what is reflected. Here is that the VIX starts to march up towards mid-October, early to mid-October, before it starts to drop again into the holidays. So this is seasonal effect, right? So we're looking at this over the last 25 years or the last 35 years, and you can see that this is sort of playing out. Here's your year to date. So we're maybe pushing a little bit further into the seasonality, but this is the idea, is that we're starting to do this now. We're up into the 20s. So here we are today, because this is yesterday's news. Here we are today, and now we're starting to catch up to this trend that we, in theory, should be seeing over some time. Here is the economic policy. We're also pretty high on the fear on the greed index. Here's your economic policy uncertainty in the VIX. So the economic policy soaring into the tariff news. I don't know how great this is as an indicator, but uncertainty really, really soaring. And then, of course, the VIX, which is now up here. So uncertainty is this gap. So the idea is that, well, either uncertainty has to come down to meet a tame VIX, or the VIX has to rise in order to meet higher levels of uncertainty. We don't know exactly how that's going to work. At some point, I think it's going to work in a big way, because I think the market's going to have some trouble on the unemployment side, on the employment job side of things. Here's Berkshire. So of course, Warren Buffett's not a short-term trader, but here you go. It's he's sitting in a whole bunch of cash. So take that for what it's worth. Let's talk quickly about I think it's quite interesting to see some of these earnings. Let's talk about Amazon. So here's Amazon's earnings, where they didn't like them, right? So what happened was Azure, Microsoft's cloud numbers were phenomenal, absolutely phenomenal. Google's were good. And then Amazon came up short, and so people are worried about that. I'm not worried about Amazon at all, because I think the difference is here is that you have a delayed reaction from Amazon Cloud. Nothing is going to stop cloud at this point. The big cloud delivery mechanism companies are going to do fine. It's just that Microsoft and Google have something that that Amazon doesn't have. They have an ecosystem, right? So what's very interesting about the way that we can see cloud at this point is, and you see that Azure AI basically tripled in usage, right? So people are using that because, once you're in the Microsoft ecosystem or Google, it's very difficult to leave. You can switch from one to the other, but it's very difficult. You get used to it, and why bother, right? So we'll see as they raise prices over time, we'll see what the market can tolerate. But the market's going to be excited about that, because the more you rely on that ecosystem, the more pricing power they have, right? They're going to start inching up prices because they know that people aren't going to be able to leave. And they know that they're getting much, much more value now via the Copilot, which, believe it or not, is being used a lot. They're getting more value out of AI, right? So they're going to say, well, I can't leave. I'm getting more value. And it's sensible, right? Microsoft should probably raise prices. They're spending a lot of money on AI. But what Microsoft has is this built-in distribution through this ecosystem, through Office 365 and Word and Excel and Teams and things like that. So very enterprise heavy. Enterprise will spend money versus, you and I might be like, I'll try something different. I'll try like free, whatever that free offices version is. Enterprise don't really work that way too much. So it's very, very sticky, right? It's a very sticky business. So what this highlights is that, and I've had people sort of say to me, well, how much money is GPT going to make selling $20 chat GPT? That's not the point. The point is the real value and money is going to be how somebody uses AI in order to drive some sort of value in your life, in your business life, in your personal life. That's where the value is going to be. That's where somebody will pay a good amount of money if you are able to use it to your advantage, right? So in a sense, Microsoft isn't selling AI, it's selling you a way to work, a way to live, a way to organize your life. And that is the incredible value. And it's the same thing for Google because they have that productivity suite as well. Let's take a look at Apple. Pretty amazing numbers across the board. As some of you know, I'm a fan of Apple. I think it's going to do well eventually because they're just this far away from basically having AI in your pocket. They can figure it out. They've done a number of acquisitions. Cook came out and said, very open to M&A that accelerates our roadmap. That's what people wanted to hear. They want to hear that we are looking, and we're waiting for the right moment. And expensive phones, doesn't matter. We've already had that argument long ago. Of course, you can switch to a cheap Chinese phone or whatever's out there, Android phone. People are not doing it the way that perhaps you think they should. They love the product. They love the whatever the status that it gives you. People spend an exorbitant amount of their disposable income in some countries to own an Apple iPhone. It just Apple is it. It's the cool thing. Once they figure out AI, it's going to be really, really a big pusher. The new phone sold very well. Wait till they come out with something that they claim at least has this, kind of closer tie to AI. They're going to really enjoy this upgrade cycle. So we talked about Amazon and then Meta. I mean, Microsoft, we talked about Meta just killed it all around, right? They basically have half the people on Earth using some part of their ecosystem, right? Whether it's Facebook or WhatsApp or whatever, they're just amazing, and they are a great example of. And I said this months ago. This is where you are seeing monetization right now, right here. It's not spending money to perhaps make money on it. These guys are figuring it out. And it's almost getting to the point where you're getting almost rewarded for saying you're going to spend money. Because think of how AI, this phase of AI is going to be like running water. This is the printing press. You got to be on board to various degrees, right? If you're a company and your two competitors are using this stuff and they're getting these productivity gains and these cost savings and et cetera, and you're not doing it, you have an existential problem. So that's what's going to drive this. We're getting a sell-off today. It could go on. I said maybe we get 200 or 300 points of sell-off. But in the long run, I think we're going to have another leg of the melt up because this is just so big to the specific companies that are building this in terms of the picks and shovels, the people who grab the data, who sort it, who sell GPUs, this and that. We are seeing fractioning even within the chips industry, right? We see ASML, TSM, a number of stocks that haven't done as well, AMAT. So it's not all champagne and strawberries, but it's generally a place where I think people have to push money because it's an existential reality for companies. Vinod Khosla said, in the 2030s, we may be looking at many huge S&P companies that are going to disappear as a result of AI. It may be of no fault of their own because it's just a new world. But if you don't figure this out, you're going to be in trouble. So again, I think that's pretty much it. We can see some of the here's soaring demand, absolute massive data center capacity demand. It's not going away. It's not going away. It just isn't. It's not that cyclical, right? It's not cyclical. We get a little bit of a slowdown in the economy. Nobody's pulling back. What they're going to do is what Microsoft is basically doing. They're firing people so that they can afford. I mean, they can afford anything. They're getting rid of people in order to afford the AI build out. Right? So this is not cyclical. If companies have to do this, if they have no choice but to do this, they're going to do it, and they're going to cut costs in other places. You're not going to have your coffee machine in the cafeteria anymore because these guys have to push AI. Look at this: $5 trillion in capital expenditures on data centers over the next few years. This is unstoppable. That doesn't mean stocks are always going to go up, but it's unstoppable. So let's look at this is what we're hopeful of, that basically we can keep spending. No one wants to pull back on spending, that's for sure, which is a problem. And you can sort of see the CBO forecast of just endless federal debt. This is how AI, just as the internet gave us some productivity gains, we can see how AI could make us much more efficient and stave off the U.S. fiscal problem. This is what is going to be required, I believe, and ultimately we're going to see rates come down because I think AI is going to be incredibly deflationary. Powell's keeping rates higher. If somebody even said, I think he was even hawkish, which means he might even raise rates at some point. I think anything can happen, but I think in the longer run, it's not a great situation. So let's look at some flows here. We can see this is the kind of stuff I've been talking about for the last couple of months, saying, listen, there's more room to the upside. The pain point is up. Anybody watching my show has said, listen, nobody's in this market and the pain point is up. It's as simple as that. I did think we'd sort of pause maybe around 600. We kept going. But here we are. We can see these vol controls. So think of something like this. It's a little bit deeper. If you don't want to watch this, then skip over it. But this is where these sort of systematic strategies, I kind of call them the Terminator strategies, because they don't have emotion. They just do what they need to do. When volatility gets low, when the market is just very, very quiet, they're allocating to the market. Like they're buying stocks, they're buying futures. When the market volatility gets really, really high, as it did in April of this year, they need to de-risk. They need to get out. They just do what they got to do. And you can see they went to almost. This is actually not even. This is your 3-year look back percentile. The shorter term version actually shows that they were almost completely out, which you almost never see. Just almost 0 percentile of allocation to the market. So there was really nowhere to go but up, because CTA, vol control funds, these sorts of things just got out, right? So these there's no guarantee that it means markets will go up when they're very low allocated, but it's fuel to the fire, right? So think of things as you trade as always, well, what's fuel to the fire? What is it? How durable is this move? And this just kept going up, going up. Now they're kind of getting back in. They've gotten back in. And so there's that tailwind is now kind of gone, right? CTA, think of that, commodity trading advisors. It has nothing to do with commodities. It's sort of systematic, kind of strategies. It could really getting short even at one point in April, and now all the way back in. So now they're back to all-time exposure. So when you have some strategies that have some heft and weight in the market, we're at the 98th percentile of exposure. So there's nothing left to buy from the perspective of these funds. So we may have found a bit of a top here in the short run if we also consider the seasonal. Remember we talked about August, September, and the VIX kind of going up and people getting a little bit nervous. Remains to be seen if AI overcomes that, right? These are not times as usual. These are different times because of that. But having said that, some of these forces have really, really come back into the market. And so one thing I wanted to do was show this. Here we go. The spillover. One thing I wanted to show is the spillover from the meme craze, right? So if you look at 2021, there was a lot of kind of craziness, as this shows the percentage of top 100 stocks in the S&P that ended up having inverted call skew. That means just kind of excitement to the upside, people just buying calls no matter what, like doesn't matter what the price is, short covering. That's what happened in the meme craze, as well as kind of during a bit of COVID, right? So we sort of had people really pushing into stocks in a very kind of feverish animal spirit kind of way. Then that all ended, and we had a difficult market in 2022, and then it's kind of come alive again. Now, it has come alive in certain areas, certain frothy areas of tech and AI, but what we see here is that there's plenty of room to go. So in my view, we are going to fulfill this destiny of having a really, really big frothy type market again, thanks to AI and AI inference. I think it's going to happen. We're going to see tons of IPOs. That's why I like Goldman Sachs. We're going to see this continue, in my view. There just may be a couple months of, or if that, of a kind of shakeout where seasonality takes hold, and maybe some of those stocks that have overdone it kind of give back a little bit, which I'm going to take as an opportunity to reallocate or to allocate more to some of those names. You can see speculative trading indicator from Goldman really has a lot of room to go to the upside, right? So there's a lot of room, in my view, to really push harder into the end of the year. And make this one of those years to remember. So in the meantime, we're going to struggle a little bit. So I hope you enjoyed that. And by the way, check out I have a new crypto income service as well as Leaps Trader, where we've been closing positions over the past week. And in fact, I did a protective position on Amazon right before earnings, which I'm teaching members how to do. Basically, I picked up downside protection for free, right? I'll explain how that works for free. And now I'm fine to the downside on Amazon in that position. And of course, they pooped the bed. So that position is really working out great to protect that particular Leaps position. So, you know, that's why it's called hedged Leaps Trader, because there's an embedded hedge, but there's also other things that you can do. We have some income trades on there known as poor man cover call strategies on Hood and a few other names. And of course, we've monetized a lot of great positions lately. We're going to use that cash to reposition in some of our favorite names that we think are going to do fantastically well. So check it out down below in the description. It's going to be optionswithhans.com/pricing-plans/. But check out the link down below, and then also the crypto income trader, where on iBid on Bitcoin, I've actually made more than Bitcoin has gone up over the last couple months. That is very hard to do with income strategies, exceptionally hard. Trust me, I ran 750 million in income strategies, and that is very, very hard to do. But we have a system, we have indicators, we have a time to get aggressive, we have a time to do income trades, and there's a time to not do income trades because you are not getting the value out of them. That is how you approach the income trade world. There is no other way. Or don't do income trades. Simple as that. Either you do it properly or you don't do it at all. So anyway, end of rant, end of pitch. I hope you guys have a wonderful weekend and take care. Be safe.